Consumer and producer prices crossed this Wednesday and Thursday, respectively, giving the last insight into inflation ahead of next week's Fed meeting. So how can we expect the news to impact markets? Well, joining us now is John Lynch, Comerica Wealth Management CIO. Thank you so much for joining us this morning. So, John, for investors trying to make sense of what to do, basically, in this holding period before we actually hear word from the Fed, given what we're seeing with PPI and CPI data that's been pretty stubbornly strong here, what should investors make of this?
Thank you, Rochelle. Good morning. I think the CPI report will be more important than the wholesale or the PPI measure coming out on Thursday. The wholesale prices have come down considerably, and I think that's kind of factored into the markets. But on the consumer price, the consensus estimate is up significantly from prior month's data. We had 0.2% in July, and now we're looking at 0.6%. So for the month of August. So I think that's something that maybe the market hasn't really appreciated yet. But really beyond this number, the Fed meets next week, right? So there'll be a lot of concern. I think a hike next week is pretty much off the table, but November's still in play. But I do think investors need to appreciate that the year-over-year comparisons on inflation is something that I don't think has really been fully embraced. Even if we just maintained a July pace, right, of 0.2%, by year end, we will still have a print of 4% year over year. So even though inflation is steady in that analysis, right, at 0.2%, the year-over-year number would be 4%, which would suggest inflation is accelerating. So there will be some cross currents that investors need to deal with regarding inflation over the next few months.
And certainly as we look at some of the signals, looking at the 10-year Treasury, you expect another 50 basis point increase likely in the coming weeks or months. What do you think is going to drive that next leg up from where we already are?
Yeah, thank you for bringing that up, because the market discourse now is the Fed's done or close to done. And my message to investors is that the market is not done, because for several reasons on the 10-year Treasury with market interest rates rising. First and foremost, if you just look at the technical chart on the 10-year Treasury, given where we were from the low in March to the high most recently, it does appear that 4.75 to 5% is in play on a technical basis. But secondly, on a fundamental basis, you no longer have, if you will, the size buying that we've seen from the Japanese, from the Chinese, and certainly from the Federal Reserve now that we're fully engaged in a quantitative tightening standpoint. So you have three big buyers that are no longer there. That is on top of my third point, where Treasury, as you know, announced a 30% increase in funding from where we thought we were, 750 billion, call it, for the fiscal quarter ending in September. Now it's north of $1 trillion. So we have more supply with fewer buyers. And then finally, just looking at the relative comparison between the 10-year Treasury and CPI on a headline number, the 10-year typically trades about a 200 basis point premium to CPI. So that also would suggest, even on a low print number for this Wednesday, the 10-year still could approach that 4.75 to 5% within the next several weeks, couple of months.
So then, in terms of best ways to navigate this uncertainty, especially when you think of the domino effect, if we are looking at that 10-year being the marker of what's to come, what are your expectations?
Sure, it's always a challenge with the markets, right, with rising rates. And I don't think equity investors, we have, the money supply is still so strong, and there's still such a preponderance of momentum in the growth space. I do think rising rates with a Fed that will likely maintain tight policy through the first half of next year. I think the expectations for four cuts next year are overdone. But I do think investors should reassess their portfolios. I still believe, now I've been wrong for months on this call, but I still like value over growth in an interest rate environment where you see the 10-year approaching 5%. So it's a slight overweight, but nonetheless, you talked about the Magnificent Seven earlier. There are 493 other companies in the S&P 500 that I think investors should be diversified. And we're starting to see momentum in energy. and that's coming at the expense of consumer discretionary. We're starting to see firming in the industrial space. And I also like healthcare, if you want to think about energy and healthcare from a barbell risk strategy, if you will, for healthcare's defensive strategies.
We do appreciate you joining us with your insights there. John Lynch, Comerica Wealth Management CIO. I appreciate you joining us this morning.
Thank you, Rochelle.